Brooklyn may have money. Welcome to Cramer. Anyway, friends, I'm just trying to make a little bit of money here. My job is not just to entertain, but to put it in context. Call me, 1-800-743-CNBC. You can tweet me at Jim Cramer. I never thought I'd say this, but the United States increasingly feels like a command economy, where you better accept the president's terms without complaints or suffer the consequences, which could be severe. Of course, it's not all negative. We wouldn't have had a session where the Dow lost 409 points. But wait, S&P advanced 0.41% to a record high, and then NASDAQ gained a whopping 0.91%. But let's start with the bad stuff, or at least the stuff that's bad for the stock market. Today, the health insurance companies saw their stocks get crushed. That's United Health. Dow stock, by the way, that's why the Dow is down so much. Humana, CVS, which owns Aetna. Why? Because the Centers for Medicare and Medicaid Services increased rates for the lucrative Medicare Advantage programs by just 0.09%. Normally, these rates keep up with or exceed inflation. Wall Street was looking for about 4 to 5% increase. Just brutal for the industry. Wall Street was totally blindsided. This was the work of Dr. Mehmet Oz, who's long wanted to stem the endless rise in healthcare costs. He told me about ways to cut our healthcare costs all the way back in 2018. It's an obsession of his. And this is meaningful, which we know because the stocks got obliterated. UNH fell 19%. Humana plummeted 21%.
The House of Pain.
CVS tumbled more than 14%. I'm honestly surprised it happened because both parties have checked off on these price increases for years. It's like by road. This president does not mind inflicting pain on even the most powerful of companies who quiver at what he says. At the same time, in the last 24 hours, we've seen the president's policies bolstering some domestic manufacturers. GM. It reported a huge profit boost today, sharply better than expected. Some of that's because GM has a great car and truck lineup. They've had the highest full-year market share in a decade. But GM's also been a huge beneficiary of less stringent environmental regulations, allowing the company to sell popular gas guzzlers, no fines, no purchases of EV credits. And while it wasn't stressed, GM certainly benefits from tariffs on imported cars. GM CEO Mary Barra, listen, time for you to take a victory lap. You're offering the best cars and trucks at the best prices. You deserve a huge amount of credit. And I agree with Barra when she says 2026 will be even better. And we have to credit this business environment and the president's support for some of that success. Shareholders did well. GM stock jumped almost $7 or 8.75%. What else? Last night, Nucor, our largest steel company, reported a mixed quarter. Its shares pulled back today, but the stock was up at its 52-week high coming into the quarter, and the actual print wasn't nearly as good as the stuff underneath. I think there were many positive factors, but what's key? Nucor's being protected by steel tariffs that block foreign products from being dumped on our soil. Remember what that means. They are making it and selling it for less than their cost of production and wiping out our steel industry. No more. As CEO Leon Topalian said on last night's call, quote, what we've seen out of Commerce and USTR is a very supportive trade environment that's pro-American and pro-U.S. manufacturing. Topalian told me that the import picture is best in his 30 years at Nucor. On the other hand, though, the defense contractors saw their bottom lines crimped by the president's efficiency crackdown. He's demanding quicker results for the Pentagon. Boeing had to take a hit on a big tanker contract where the government wants more timely product. As CEO Kelly Ortberg pointed out, quote, as you know, the Department of War is super focused on us first of all, making investments to support growth and also ensuring we're delivering on time. And so we took that decision, albeit a big gulp, to have to take a charge here on the tanker program, end quote, ouch. It killed the stock. It was down. It would have been up big if it weren't for the charge. But so what? It wasn't. At the same time, though, Ortberg did credit the president for a hefty increase in Boeing's backlog. Still, the charge brought out the sellers. Some are just too tired of the company's missteps. Now, it is a big position for our charitable trust. We told club members at our morning meeting, which is broadcast at 10:20, stick with the program. Then there's RTX, which had been singled out by the president for being least responsive of the defense contractors to the Department of War's demands for quicker, better munitions and fewer buybacks. That was in a True Social post. The company addressed these concerns several times on the conference call. It was very responsive. I've known RTX to be a huge repurchaser of its shares in the last 5 years, a serial buyback company. Not this time. The key contractor for the Golden Dome project, it didn't buy back any shares this quarter, saw its share count grow, which should cause a 5-cent per share earnings headwind this year. They got the message. As CEO Chris Callio explained, quote, we fully support the Department of War's transformation objectives to significantly increase capacity and accelerate production over a sustained period, end quote. My conclusion, the True Social post worked. Now RTX is on board. The stock rallied nicely. They're going to keep the dividend. But, wow, buyback? Hardly a day goes by when we don't see some government intervention in the economy. Yesterday, I spoke to Jensen Huang, CEO of NVIDIA. He was in China. Jensen likes to visit China during the Lunar New Year. He seemed confident that he could win some meaningful Chinese business. But he said he'd prefer to keep the potential contracts out of any earnings estimates for the time being. We ran out of time in the interview before I could ask him how NVIDIA would account for the 25% of China sales that are supposed to go to the U.S. government as part of the bargain the firm struck with the president. Is Trump being greedy when it comes to the semiconductor industry? The government bought 9.9% of Intel at $20.47. Even after last week's shortfall, the president has more than a double on his $8.9 billion investment. Now, the government technically didn't write a check, okay? The investment came in part from a conversion of unpaid grants left over from Biden's CHIPS Act and a classified black box program it had with the Pentagon. NVIDIA stock, by the way, finally showed signs of life. It's only up 1% for the year. I think that's ridiculous. I think it should catch up with the rest of some of these big Mag 7 names. And how about Salesforce yesterday, winning a $5.6 billion 10-year contract from the U.S. Army to streamline procurement and cut costs? The Pentagon's turning to commercial software loaded with artificial intelligence like Salesforce's Slack product. It's an out-of-nowhere contract that few thought Salesforce was even going for. This company belongs, though, to the beleaguered software as a service segment of tech. It's a group that is so in the doghouse that the stock of Salesforce actually fell 87 cents, despite this obviously great news. I don't know what it'll take to get that group moving. Maybe when ServiceNow reports tomorrow, it can change the narrative, but that's a tall order given that the competitive threat from generative AI has got all these hedge fund managers spooked. Still, what I want to talk about is all this government intervention, of course. Yesterday, Uncle Sam made an investment in the money-losing, heavily shorted USA Rare Earth Inc. Then there was the canceling of $4.8 billion in Treasury Department contracts with consultant Booz Allen Hamilton for failing to install adequate privacy safeguards. Put it all together, and you have to factor in the government as both a positive and a negative, no matter what you do. And we know the president isn't done with trying to get that one-year cap on the credit card rates at 10%. How do we know this? Because the banks relying on credit cards have seen their stocks shellacked again, while those that don't have credit cards keep rallying. It might go away, but the stocks say don't count on it. The bottom line, it's an amazing and a preposterous time in so many ways, good and bad, depending upon how you look at things. But one thing is for certain. We have a level of government intrusion in private enterprise that I haven't seen since before the Reagan administration. Makes me feel like a kid again, back when I had a full head of red hair. Rebecca in New York. Rebecca!
Hi, good evening. It's a pleasure to talk to you.
Same.
I'd like to discuss with you this stock. And before I do that, I just wanted to say that a lot of people now, unfortunately, have cancer, including my daughter that just passed away at age 42 from colorectal cancer. And so I just would like to encourage everyone age 45 and above to get a colonoscopy to prevent colorectal cancer. So my question is about Moderna. They're working on a cancer vaccination. Should I buy Moderna?
Well, I got to tell you, this is something that they did promise a long time ago, and I hope that it's for real. I'm sorry about your daughter, and that is the worst form right now, the biggest cause of death. Of cancer. I do say that we have to wait and see. Why? Because the stock's up so much, 54% for the year. I just want to know how certain things really are. Let's go to Billy in Connecticut. Billy.
Hey, Jim, my annual Happy New Year call to you, buddy.
Right back at you. What's happening?
At what point do I stop saying Happy New Year? Like after Q1?
It's a tough call. My birthday's Feb 10. No one. That's when you switch from wishing me Happy New Year to wishing me Happy Birthday.
I gotcha. I wanted to ask you your thoughts on companies that make and sell commercial airline parts. So, Jim, tell me if the stock is on your radar, and is she ready for takeoff? Do I buy Air? And
I've been recommending Air forever, and we know it's up 27% for the year. I saw that I think it was Goldman started with a neutral. This thing is can't miss. We had John Holmes on recently, and it is just part of the great aerospace boom that has no sign of slowing down. Cordell in Ohio. Cordell.
Hello, Jim. Thank you for having me on today.
My pleasure. What's up?
I'm calling in about a company that was down last year about 40%. Currently, year to date, it's up about 5%, and it's trading right around about 4.5 years lows in around August of 2021. And it had a new relaunching of more high protein products and seasonal products. Is Chipotle a buy? And if so, where's a good
a lot of people are warming up to Chipotle down here. It has had such a decline. It only sells for 34 times earnings. I say only because I've seen it at a much higher price earnings multiple. I think it's actually a decent level to put some stock on. They have report on Feb 3rd. Remember, it might go back down to that $30 low, and you might have to buy a little more. But wow, what a good franchise at a very reduced price. All right, look. We've never seen this level of government intrusion in private enterprise, well, maybe not since before Reagan. And it's creating winners and losers every day in the stock market. So please invest accordingly. Keep an eye on Washington. Keep both eyes on Washington. Make more money than both eyes on Wall Street. On Mad Money Tonight, the shortage of memory and data storage products has created some big winners in the space, but I'm revealing an under-the-radar way to play the boom in case you've missed out on the rally so far. And speaking of rallies, the run we've seen in gold and silver has been nothing short of historic. But could we be nearing a top, or even worse, a blow-off time for the precious metals? I'm going to find out. And D-Web Quantum is holding its annual quantum computing conference this week. It's got some big contracts. I'm going to sit down with CEO, find out a little bit more. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
How do you play the memory boom without chasing these data storage stocks? The four big players in the space, Micron, Western Digital, Seagate, just reported, and SanDisk, each one tripled last year, and they keep running in 2026. Just since the beginning of the year, SanDisk has more than doubled. The other three are up anywhere from 35 to 50%. I don't want to chase those. I don't chase the storage and memory plays because even though there's a severe shortage of this stuff thanks to the data center build-out, it really doesn't take much to derail these commodity chip makers. Maybe the Korean competitors like Samsung, SK, Hynix will expand their production capacity without our knowledge. Maybe the hyperscalers look at the sky-high prices of memory and data storage products and decide it's time to dial back their data center investments. Possibility. We'll find out soon enough. Even the smallest disruption could crush these stocks. I've seen it happen so many times before. Given how much they've already run, if you don't already own them, let's just say I think you're too late. But there is a relatively safer way to play the same theme. These are not safe stocks, but safer versus those others. And that's the semiconductor capital equipment plays. Whenever there's a chip shortage like we have now, sooner or later, these companies start buying more manufacturing equipment in order to boost production. That's why ASML, Applied Materials, KLA, and Cramer Fave Lam Research have been roaring, because people know that they'll have big orders as the year goes on. The big four semiconductor capital equipment makers rallied like crazy last year. They're up anywhere from 29 to 39% just since the beginning of January. You're not early, but they haven't run nearly as much as the storage and memory makers. So relatively, they've still got more room to run. Plus, I think this industry has a lot more going for it. 2 weeks ago, Taiwan Semi, the world's largest semiconductor manufacturer, reported a total blowout quarter. More important, management said that the demand's on fire. They plan to invest heavily in building out their production capacity. For this year, Taiwan Semi guided for $52 to $56 billion in capital expenditures. That would be up 27 to 37% from last year. Wall Street was expecting less than $45 billion. When management was asked if that would be enough to fix the chip shortages, their answer was a clear no. Taiwan Semi doesn't see supply and demand coming into balance until 2028 or 2029. So they're planning to keep their capital expenditures high for the next few years. Again, great news for the semiconductor capital equipment makers. Now, the specific commentary was about Taiwan Semi investing to meet demand for AI semiconductors, not necessarily memory or data storage chips. But if anything, that's better for the capital equipment makers because manufacturing AI chips requires more advanced hardware. ASML is best positioned for this type of leading-edge equipment, but all of the big four semiconductor capital equipment companies participate in the market, which is why they all had such huge gains in response to Taiwan Semi's quarter. rational. We got another big clue the very next day when I got a chance to interview Sanjay Mehrotra, the CEO of Micron. What a stock, what a company, on Squawk on the Street. That's when Micron broke ground on a $100 billion semiconductor foundry in our state, New York. While that facility won't be up and running until 2030, you better believe it needs equipment. On top of that, Micron's working on a new fab in Boise, Idaho, which will begin adding output by the second half of 2027. Micron also broke ground on a new fab in Singapore yesterday. That should start producing in the second half of 2028. Dizzying, right? The key takeaway, Micron's investing in new production now, and it'll continue investing in new production for several years into the future, which means consistent orders for Lam Research, KLA, and Applied Materials. Buy. Finally, when Intel reported last Thursday, the stock got clobbered. Remember, it was down 17% on Friday, another 5% on Monday, before stabilizing today. That's not because the numbers were bad. The quarterly results were actually quite good. Instead, Intel gave dismal guidance because they just don't have the ability to meet the demand for their chips. From my own reporting, I've found out that Intel simply doesn't have enough manufacturing equipment. It didn't predict the strength of its own markets correctly. Again, as with Taiwan Semi, this isn't about memory chips. In this case, it's CPUs that Intel can't make enough of. That means more business for the capital equipment makers, especially Lam Research. CPUs are the bread and butter. Lam's also one of the leading providers of the type of equipment used to make memory chips, so they'll be one of the first companies to benefit as the memory and data storage companies look to boost their productions, which I know they want to. That's why this stock rallied 137% last year before tacking on another 39% gain in January. Now, some of these semiconductor capital equipment companies will be reporting earnings in the next few days. ASML reports tonight, overnight, from Europe, so we'll have numbers when we get in tomorrow. Lam reports after the close tomorrow. KLA reports on Thursday night. Applied Materials we don't hear from until mid-February, but while I expect all these companies to report great numbers, the bar is now incredibly high given how much their stocks have run. So I can't say for sure how their stocks will react as they are what I say coming in hot. But that brings me to a very smart analyst note from Lynx Equity Strategist that came into my inbox. It was published this morning. The Lynx analyst says that a beat and raise result is already baked into Lam Research stock. I agree with that. It's hard to argue with. But the analyst is still very bullish on Lam, and that's because they expect much better numbers in 2027 than the rest of Wall Street's looking for. I agree with that. If management gives a qualitative view of wafer fab equipment into 2027, and we hope that not everybody is starting to build out at once, the Lynx analyst argues that the stock could soar. Otherwise, he expects it to sell off because it's up to 39% over the past few weeks. If Lam Research does sell off, though, that may be the real opportunity. I would be a buyer. I believe in this group long term, and Lam is my personal favorite. It's incredibly well run, and its antecedent, Novellus, for anyone who watched the show all the way back in 2005 to 2012, was my favorite semi-cap equipment company of all time. Here's the bottom line. If you want to play the memory and data storage without chasing stocks that have tripled or quadrupled in barely more than a year, I think the semiconductor capital equipment makers will be more durable winners here. I think Wall Street might not fully appreciate the long-term capacity expansions coming through the entire semiconductor ecosystem. While I don't know how these companies will do when most of them report this week, that doesn't interest me. I hope the stocks pull back, because then you've got my blessing to buy them for the long haul, which is what we care about on Mad Money. Mad Money's back after the break.
Coming up, gold and silver have soared to record highs. But could the metals market be heading for a meltdown because of it? Cramer's going off the charts to find out. Next.
We keep trying to figure it out. I mean, what in the world are we supposed to make of this monster rally in gold and silver? It simply refuses to quit that I know so many of you are compelled to play in. To answer that question, I want to go off the charts with Carly Garner. She's a brilliant technician, senior commodity market strategist, broker at DeCarly Trading, and the author of DeCarly Perspective newsletter. She's our resident commodities expert. She knows things cold. As Garner sees it, gold and silver both had legitimate reasons to run, but the magnitude of these moves has become impossible to justify. She hasn't seen silver running like this since 1980, when the market was cornered by the Hunt brothers. This time around, she thinks it's something similar, except the culprits are less identifiable, likely consisting of both momentum traders and governments around the world that are stocking up on precious metals. That includes, by the way, countries that aren't exactly friendly with the United States. If you don't trust the dollar, like I don't, and you need to put your reserves somewhere, gold and silver make a lot of sense. I have felt that way about gold since the show started more than 20 years ago. Whatever. I felt it that way when I was with Kudlow and Cramer. All the way. Now we're talking. We're dating me. At the same time, we've got all these highly leveraged ETFs that let you make triple long or triple short bets on commodities, including gold and silver. When you have a big commodity rally, those ETFs often add fuel to the fire, although that could end badly. As Garner sees it, these leveraged ETFs have wildly magnified our usual commodity boom and bust cycles. She thinks that's part of what's happening to gold and silver. On top of that, there's simple fear of missing out, FOMO, given how much these metals have already run. We don't talk about these ETFs, by the way, nearly enough on the show. And there are scores and scores of them, and they are moving the markets in a very outside fashion with very little money wagered. And make no mistake about it, these are wagers, not investments. Now, Garner points out that commodity markets, they trend often to culminate in large spikes in volatility as traders on the wrong side of the trade capitulate in both the futures and options markets. And latecomer FOMO traders finally pull the trigger. So let's go to work here. Take a look at this chart of the CME Group's CVOL index for silver, which is like the VIX for silver. You can see that silver options market volatility has now surpassed what we saw during the COVID crisis and the metals peak in 2021. When the implied volatility in silver got this high in 2020 and 2021, both times it slaughtered the bull like that. Okay, now, if you want to understand what's really going on here, Garner says you need to take a step back and take a look at a 50-year chart of the action in silver. Way back in 1979, 1980, a group of oil billionaires, the Hunt brothers, tried to corner the silver market. They sent the price of silver from around $5 an ounce all the way to $50. This was the corner an ounce before the commodity exchange changed the margin requirements, and then the metal got crushed. Look at that. Is that ever determinate? Now, in late 2003 and early 2004, another bull market picked up steam, silver running all the way again from 5 to 50 in 2011, driven by a historic explosion in market volatility. Everybody was hedging against the great impact of the Great Recession and the European sovereign debt crisis, which was really in evidence right there. Why bring this up? Because even though the price of silver pulled back from its high today, it's up nearly tenfold from its 2020 lows, including a quick 57% gain just since the beginning of January. In Garner's view, you don't get moves like this unless the economy is about to collapse or someone's cornering the market. Now, when you look at the monthly chart of the silver futures, you can see just how extreme this move has been. You see the green line above the price and the red line below? Well, these are what's known as Bollinger Bands, and they help measure the level of volatility. I've always liked them from the days when Bollinger used to come on CNBC many, many years ago. Garner points out that the last 3 monthly price bars have traded almost entirely above the upper Bollinger Band, which represents 2 standard deviations from the average. Normally, basic statistics say prices should stay within these bands about 96% of the time. In fact, this month, silver has already made a 3.5 standard deviation move. The only time in history we've seen such a big run was when those guys cornered the market in 1979. Now, we keep hearing about the corner. So when will it end? Garner's not sure, but she's got a good idea of how it will end. Right now, the relative strength index, the RSI down here at the bottom, an important momentum indicator, is hovering at 94 on the monthly chart. This is an extremely overbought reading. Even when silver rocketed higher in 2011, the RSI never got above 86. If you remember the scale of past silver rallies, Garner says we should expect buying to dry up between $110 and $120 an ounce. Sure enough, after shooting at 115 yesterday, silver has sunk back to 112 and change today. Then again, she wouldn't be surprised if it didn't make another run. It can make a run to this monthly trend line, and that would be around $135, if only because this market's going so crazy. All right, now, when the 2011 silver bull market ended in an explosion of volatility, it fell back into what had previously been a comfortable trading channel, as represented by the blue lines on the chart, okay? You can see it went all the way back, all right? If that happens again, we're talking about price range of $19 to $40 an ounce. Whoa, I know that probably sounds too low to you, but remember, Garner points out silver was trading at $40 an ounce about 4.5 months ago. Pretty remarkable. Of course, if this time is truly different, meaning governments and investors around the world are abandoning fiat currency for hard assets, as we talked about last night with the Nico Eagle, then Garner says we could see floors of support at 100 and then 78. So now, okay, we're done with silver. Let's look at gold. Take a look at this chart showing the volatility in gold going back to the financial crisis. Current gold market volatility matches the 2011 volatility, okay? To that peak, triggered nearly 50% correction and decades of languishing prices after that. It moderately surpasses the 2020 volatility. So that's a spike that set gold back about 25% over the next 4 years. This is the highest gold volatility has been seen since the financial crisis. That's very meaningful because we obviously do not have anything like that going on right now. Again, Garner points out that this kind of volatility spike almost always precedes a trend reversal. Okay? We don't know if we're going to get that, though. When you look at the monthly chart of gold, let's take a look at this. It's very similar to silver, except that gold didn't break down today. I know, a lot to look at, but didn't break down. Like silver, gold's relative strength index, the RSI, is in the mid-90s. Extremely overbought. Yet that hasn't been able to stop the rally. I can't believe that didn't stop the rally. It's unbelievable. I've never seen anything like this. This precious metal has blown through levels that technicians normally rely on for higher probability trades. Just right through them, knife through butter. Once gold broke its trend line at 2,900, nothing has been able to stop its momentum. Nothing. A multi-month pause near 3550 proved to be a launching pad for another run to the final trend line that dates back to the early 2000s. This trend line comes in at 5,100, roughly yesterday's high. If the metals have a chance at pulling back, this is it right here. Multi-decade trend lines, historic explosions of volatility, and a nearby expiration of the February futures contract are all potential catalysts for what Garner regards as a sanity-saving correction, or even what I call a blow-off top. Blow-off top. Keep that in your mind. The bottom line, the charts as interpreted by Carly Garner suggest that gold and silver markets are busted. They're broken. They've moved up so far, so fast, that Chicago Merc Exchange had to change the way it calculates the margin requirements. Looking at the level of volatility here, Garner's betting that the strength in gold and silver can't last. But then again, sometimes commodity markets can stay so nutty, so crazy, for longer than you can stay solvent if you bet against them. Holy cow. Let's take calls. Kathy in California. Kathy.
Professor Cramer, I hope you're having a good day.
It is a good day. As a matter of fact, it's a fast day. I say that to my colleague Jeff Marks. What a fast day. Go ahead.
Okay. I purchased 1,000 shares of Ramaco Resources in December at $17.30 a share. Stock is up 34%. My question to you is, should I increase my position or hold?
Well, metallurgical coal is something that I have historically felt should have its day in the sun with this president that we have. I actually going to take the other side of what a lot of people are going to recommend to you. I want you to stay in it. I just think it's a great contrary play. You got to be in it, and I'm really glad you brought it to our show, because this may be the one. This may be the time that it works. Anyway, look, the charts as interpreted by Carly Garner suggest that the market for gold and silver are busted. She doesn't believe the rally can last forever, but the commodity market can stay crazy for a lot longer than most think. Okay, Mad Money. What else is ahead? D-Wave Quantum, fresh off a new acquisition last week, is D-Wave, which I know you like, poised to be the leader in the world of quantum computing. I'm going to sit down with the company's top brass to find out. Then sometimes the best investment ideas are hidden in plain sight. And tonight I'll reveal which company fits the thesis now more than ever after a massive move higher today. And of course, all your calls for Happy Friday tonight's edition of the Lighting Round. So stay with Cramer. I remember back in the fall, I warned you away from all sorts of hyper-speculative stocks because I saw the year of magical investing coming to an end. And that did include the quantum computing plays, including D-Wave Quantum. Sure enough, after peaking at nearly $46 and change in mid-October, D-Wave did fall roughly 60% from its highs. But since then, it has been able to rebound from its lows, including a nearly 4% gain today, as the company held a customer conference where they announced a series of very intriguing commercial agreements and partnerships, which is what we're looking for. Is it safe to speculate on something like this? How about a long-term investment? Let's check in with Dr. Alan Barrett. She's the CEO of D-Wave Quantum to find out. Dr. Barrett, welcome back to Mad Money.
Hey, Jim. Thank you for the opportunity to once again speak
All right, so Alan, you've got your conference. What are some of the highlights and what's the buzz there?
Yeah. So this is our 2026 Customer and User Conference. We're holding it here in Boca Raton, Florida. And this morning we announced several very important advances for the company. First of all, we announced a $10 million enterprise quantum compute as a service deal with a Fortune 100 company. This is to work together to build and deploy into production multiple applications. We also announced a $20 million system sale to Florida Atlantic University. So far, just in the first month of 2026, we have $30 million worth of bookings. Next, we announced an important partnership with Davidson and Anduril to work on Department of War applications. We announced that we are moving our corporate headquarters from Palo Alto, California to Boca Raton, Florida. And then this all comes on the heels of an earlier announcement a few weeks ago where we announced the acquisition of Quantum Circuits to put D-Wave into the leadership position for both annealing and gate model quantum computing.
Well, let's start with the Florida Atlantic, purchasing advantage to quantum computer. Now, Florida Atlantic happens to be there, too. I don't know whether that had an influence on where you move, other than the fact that I would rather move where you are than here. But that does seem like $20 million. That's a big deal. So what do they get for a $20 million agreement that you are installing an advantage to annealing quantum computer right there at their campus?
Yep. So they will get 100% access to that quantum computer. And because they've purchased it, they will have the ability to control all of the operating parameters of that system, enabling them to explore a variety of different customer applications, commercial applications, as well as to do important scientific research. And, they will be the lead university here in Florida for quantum computing, but all the universities here will kind of come together and leverage this technology.
At the same time, your acquisition, I know that you got some affiliation with Yale. A lot of the universities have. I know Harvard has it, too. This is where quantum has been actually developed the most because a lot of companies that are large tech companies, other than, say, IBM, really haven't focused on this. So tell me about the rationale for the acquisition.
Yeah. So D-Wave is the world leader in annealing quantum computing. We've talked about this before. Mm-hmm. Annealing is very good at solving a variety of different important problems, especially good at solving business optimization problems, which represents most of the important hard problems that businesses need to solve. And our annealing quantum computers are commercial today. We have customers using them on a daily basis as part of their business operations. But then there's also gate model quantum computers. Gate model quantum computers are good at solving a very different class of applications. Most quantum computing companies in the world today are developing gate model systems. With the acquisition of Quantum Circuits, we have basically moved D-Wave into a leadership position with respect to gate model quantum computing as well. So we're now leaders for both annealing and gate, sort of one-stop shop for quantum computing.
All right, now tell me about the Fortune 100 customer, because, again, develop and deploy several quantum-powered applications. These are commercial applications. I had asked for that you have commercial applications where I felt that I should really bless the situation. You are producing commercial applications. Talk to me about this one.
Yeah. So, again, this is a Fortune 100 company that has a number of different applications that they've basically been unable to solve as efficiently and as effectively as they need to be able to solve them. This is a large company that has very large, complex applications, and they've started working with us to leverage our quantum computer on an initial application. They saw excellent results with that, and so what they've now done is they've purchased essentially the ability to develop and deploy multiple applications over a 2-year period for $10 million.
Well, okay, that's terrific. And then I know a lot of us are concerned about Anduril and what they can do for the Department of War. How will they be using your computing?
Yeah. So once again, there are a variety of different applications that we have started to work on with Davidson and Anduril. There was an initial application that we developed with them, saw very good results on it. And so now we're moving that on to a variety of other applications. These are all, sensitive Department of War applications. But what I will say is that we are also in the process of certifying our quantum computer at Davidson. One of our annealing Advantage 2 quantum computers is housed at Davidson, and we are in the process of certifying that to be able to support classified government applications, which is where this partnership will ultimately go.
Well, look, I got to congratulate you. We put out the challenge. You met the challenge. These are all very exciting commercial agreements. And congratulations. I think it's good news. And I hope you have a good rest of your conference. Dr. Alan Barrett, D-Wave Quantum CEO, QBITS. Thank you. Thank you so much, Alan.
Thank you, Jim.
Yeah, money be back after the break.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. Chris, everybody, wrap our gold same to start to buy sales, no close, Chris, my steppers, play this out. And then the lightning round is over. Are you ready? Ski dash on the lightning round. Let's start with Guy in New York. Guy.
How you doing, Jim? Booyah. Thanks for all your help. I just wanted to say, aside from Cook's caught the ball, I was interested in a stock that's looking pretty good, but it's got one little red flag, and that's regarding the insiders selling without any purchases. But it's Mueller Industries, MLI.
Mueller, do you know that I was a big holder of that when it came out of bankruptcy? I've been a gigantic believer in Mueller. I know it's been nothing but straight up, but you know what? Slow and steady wins the race. I am still a buyer of Mueller Industries. That's a lot of pipes, a lot of infrastructure. Used to be a lot of manhole covers. Let's go to Joanna in Pennsylvania. Joanna.
Thank you for taking my call. I'm on a stock called FIG that's gone down over 20%.
Yeah, they bagged people on that one, man. People, actually, I shouldn't say that. People got too excited about it. FIG was very good design software, but you know what? You got Adobe out there just flailing, and I don't want to touch design software. I really don't. I think it's just too hard. I'm going to go to Dave in Illinois. Dave!
Dr. Cramer, Godspeed Healing wishes to Lisa, recovering from knee surgery.
Not going that. We're taking a long time, Dave. Thank you for asking. I'll certainly pass that on. What's going on?
Jim, this $30 billion company is among 13 companies in the S&P that grew triple digits last year. They supply HVAC and related systems, supporting the race to build out data centers and AI stacks. Jim, your thoughts on Comfort Systems?
No, it's fixed. I remember that stock, Dave. I have to tell you, I like that stock when it was like in like that, I don't know, like $20, and I should have just said over and over again, keep buying it. So I'm very much like Mueller. It's just like one of these stocks. I think you put some on, and then if it comes back down, for heaven's sakes, you buy more. It's a great company. I need to go to Rohit. Oh, thank you for the nice comments about Lisa. Let's go to Rohit in California, please. Rohit.
Hey, hi, Jim. First time caller. Thanks for all you do for us, and love your new book.
Which one?
I own Credo Technology.
Thank you, man. Thank you. It's bestseller. You can get it now with the club. I mean, we have all big tie-in and stuff. Okay, go ahead. I'm sorry.
Yeah, I'm hooked to the book. Thank you. So I own Credo Technology.
Which one?
Pulled back
Credo.
recently.
Oh, I mean, I don't know. I mean, optical. If I want to do optical, there's just so much. Let's just do Corning. We'll see how they do tomorrow. Wait, and then buy if it gets hit. Let's go to Wesley in Alabama. Wesley.
Booyah, Mr. Cramer.
Booyah, Wesley.
Thank you for taking my call.
No problem.
Thank you for all your sincere advice for helping people like me manage their portfolio.
Sure trying.
I wanted to.
Sure trying. Okay.
Yes, sir. I want to ask you about a core dividend stock of mine, SPH.
No, propane is way too wild. Rusty Brazil told me that a long time ago from RBN.com. Let's not mess with propane. It's just too inconsistent. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, charitable trust holding Corning just landed a massive deal with Meta. But Cramer thinks this could be just the tip of the iceberg for the company. He's laying it out for you next.
You have to keep your eyes and ears open whenever you go somewhere new, because you never know what you'll find. This is something I stress in How to Make Money in Any Market. If you use your powers of observation, if you exercise some curiosity, you can find some very, very good investments. And that's what happened to the Charitable Trust today when we struck gold with Corning, which rallied more than 15% on news of a gigantic contract from Meta for $6 billion in fiber optic cables. Back on September 12th of last year, we went to Corning plant in Harrodsburg, Kentucky, that had been chosen by Apple to make the glass for your iPhone. We sat down with Apple CEO Tim Cook and talked about Apple's long relationship with Corning, how the late Steve Jobs challenged Corning directly to make the toughest glass imaginable to prevent scratches. Jobs went directly to Wendell Weeks, the CEO, who happened to be with us in Harrodsburg, and told him he had 6 months to come up with scratchless glass. Weeks, he demurred. But Jobs famously said, you know what your problem is? You're afraid, before convincing him to do it. Oh, it's a great story. I love telling it. However, when I talked to Weeks, who was with us, he patiently explained to me that as important as Corning's glass is to their bottom line, I really ought to take a hard look at their fiber optic business. This is the division that caused the stock to boom and then bust during the dot-com era. But, taking down everything connected to the internet, I mean, even the wiring, including Corning. So I did some research, and I found out that Corning's been making fiber optic cable to link clusters of servers together in the data center. Weeks explained that fiber is a heck of a lot better than copper, the current way to link servers. Copper retains too much heat, it's less efficient when it comes to signal weakening. It's heavy, it's bulky. Fiber is light and thin. It's just a better way to move data. Wendell pointed out that copper still dominates, but his money was on fiber taking over. I came back all fired up, not just about Apple, but about fiber and therefore about Corning. So we bought it big for the Charitable Trust after telling club members that they should own it. Then today we learned from CNBC.com that Corning's selling $6 billion worth of fiber optic cable to Meta, and the stock just caught fire. As Weeks told CNBC, quote, I think next year's hyperscalers will be our biggest customers, end quote. That could be incredible, especially when you consider that any given data center has 30 to 50 miles of networking cable at a minimum. Now, today in our morning meeting, and that's a 10:20 show, Jeff Marks and I told club members, please do not sell, even though Corning reports tomorrow morning. Now, I suspect I have to tell you, after this run, a more than 15% gain in one day, almost anything they report could be a letdown. I wouldn't shock if the stock could go down, but why not take profits? Two reasons. One, if Meta won $6 billion in fiber optic cables, what will Microsoft want, or Tesla, or Google, or Amazon? And two, the actual NVIDIA chips that predominate in the data center are chock full of copper. What if one day Corning can figure out how to make fiber for the inside of the chip? Wouldn't shock me. Data centers would almost immediately burn less hot and therefore need less electricity for climate control. But I digress. I mean, really digress. What matters is that you may go into someplace, any place, looking for something, and if you have your eyes open, you might suddenly see something else, some other nugget of an idea that strikes your fancy. If I'd only focused on iPhone glass at that Corning plant, I would have missed out on something that's given my Charitable Trust a huge gain. So follow your curiosity. Drill down on what you see. Sometimes there's a terrific investment idea hiding in plain sight. I like to say, as always, bull market summer. Prompt event just for you. And here, Mad Money, I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.